Now, with changes in technology, all depositors can quickly withdraw their money. The key distinction between stable and volatile deposits is really whether they're insured or not insured, and not whether they're raised through branches, brokers, or the internet. In fact, the technology is at such a point now that I had a friend who was telling me a story about a customer of Silicon Valley Bank who was in the air the morning that the run started at Silicon Valley Bank. And when he landed and turned his phone back on, he realized he had a problem. And he immediately, while he was on the shuttle bus to his rental car, moved $50 million out of Silicon Valley Bank on his phone.
That was Eric Spitler, a former Director of Legislative Affairs for the FDIC and former counselor to the Chairman and Director of Legislative Affairs for the Securities and Exchange Commission. Currently, Eric is an adjunct professor at the University of North Carolina School of Law and is our guest today on Banking Bad, where we look at past financial crises, the lessons learned, and what we should be doing to prepare ourselves for the next crisis. In March of 2023, we witnessed a bank run of unprecedented size and speed. Silicon Valley Bank's depositors withdrew $42 billion in a single day. An additional $100 billion would have been withdrawn the next day if the bank hadn't been closed. Other similarly situated banks were threatened, two of which also had to be shut down. They represented 3 of the 4 largest bank closings in FDIC's history. The expected cost to the FDIC is over $30 billion, which ultimately is paid for by well-managed banks and their customers. That cost would have been much lower if the uninsured depositors, which included a great many supposedly sophisticated investors, had not been bailed out. So why did this happen? Are bank runs inevitable? If so, what can we do to mitigate their harmful effects? My name is John Bovenzi. I am one of your 3 hosts for this series, along with Tom Weiss and David Walker. Today, we will focus our attention on bank runs and the role played by uninsured deposits, and more specifically, on business transaction accounts. Eric, welcome to Banking Bad. Let's start with a little background. What are bank runs and why are they so harmful?
Well, thank you, John. Thanks for having me on today. I think bank runs are fascinating because they exist at the intersection of 2 fundamental human attributes, greed and fear. And so when you go out and you take your money, hard-earned money, and you put it into a bank, you have some level of confidence that the bank will be able to give that money back to you when you need it. At some point, though, if something happens to affect that confidence that you have in that bank, you're going to do the human thing. You're going to go and you're going to take your money out. Well, if a whole lot of people do that at the same time, it's going to be a real problem for the bank, because even though you put your deposits in the bank and all your fellow customers put your deposits in the bank doesn't just put it in the vault. The bank lends most of it out. Anybody who's seen Jimmy Stewart and It's a Wonderful Life knows that the money has been invested in the community. It's supporting businesses, homes. It's not all sitting there in the vault. So if everybody at the same time shows up and wants their money at the same time, the bank doesn't have it, and it can cause a failure. The fear that people have when they lose that confidence is that they'll be the last one or be the first one who doesn't get paid. And so the idea is to get there before anybody else. And so you get a run where everybody shows up at the same time trying to get their money out. Bank runs are a real problem for 2 reasons. First of all, even a healthy bank has trouble surviving a run. If everybody shows up and wants their money, the bank's not going to survive that unless they have another source of liquidity. Either they can get money from the Federal Reserve or something like that. The second problem is that bank runs can be contagious. Whenever anybody hears about a bank run, the first thing they start doing is thinking, well, what about my bank? Does my bank look like this bank that's in trouble? If you remember during the 2008 crisis and actually during Silicon Valley Bank's failure, the media was going, who else looks like this? Who's next? And they start putting this kind of information out, and people get frightened. And so you have these two elements that are very harmful with bank runs, in that a healthy bank can survive it, and it can be contagious and take down a whole lot of other banks, including healthy banks.
Well, Eric, how do you stop a bank run once it starts?
Well, it's really hard. I mean, bank runs, I mentioned that you have confidence that you put it in the bank, and runs usually start from a lack of confidence. And once you lose confidence, it's really hard to get it back. Banks can try to convince their customers not to panic and withdraw their money, but, that doesn't really work that often. In fact, at the failure of Silicon Valley Bank, the CEO went out and told the investors, don't panic. And whenever you tell someone not to panic, the first thing they do is panic. And so having individuals stand up and say, don't panic, doesn't really help. The thing I find most interesting about bank runs, and it's why I've spent some time on it, is because it has a huge psychological element that you're trying to deal with. And what you're really trying to do is find those technical financial aspects that can support or act as a defense against human nature. You're trying to prevent people from taking actions that aren't necessarily in their best interest. Back in the 30s, before FDIC insurance existed, banks used to actually do something like they would stack bills, cash up behind the teller 5 feet high, so that people would come in and they'd see all this money and they'd go, well, obviously this bank has plenty of money, I don't need to worry, and they wouldn't feel the need to withdraw their money. Sometimes they'd try to get a trusted member of the community. They'd have a priest or somebody stand at the front of the line and try and tell people, you don't need to take your money out. Trust me, you can be confident about it. In 1917, there was a bank run, and a 60-year-old nun named Margaret McKenna, who was known in the community, actually stopped the run by wading through the crowd with a big pile of cash and depositing her money into the bank and telling everybody the bank is safe. Today, we don't trust people quite as much these days. And so today, finding those trusted sources isn't all that easy. And usually only the federal government is the source that's willing and able to commit enough money to make that strategy work.
It's interesting. In our first two episodes of Bank and Bad, we looked at the First National Bank of Keystone and Penn Square National Bank, two banks that experienced bank runs before they were closed. And both had large amounts of uninsured deposits, which, as we know, are much less stable than insured deposits. At Silicon Valley Bank, the percentage of uninsured deposits was off the chart, reaching 90% of total deposits by the time the run started. Shouldn't the bank's regulators have been aware of the risks this posed and done something in advance?
Yeah, you certainly think so. I mean, bank runs have been occurring since Renaissance in Italy. And so, I mean, it's not like it's a surprise. I think what has happened is, since the creation of the FDIC and federal deposit insurance, bank runs just aren't as common. People whose deposits are protected don't feel the need to withdraw their money in a run. They know they're protected by the federal government. And so generally you don't have runs connected to bank failures, but they do still occur. And they particularly occur, not surprisingly, at banks with large amounts of uninsured deposits. I mean, probably one of the most significant failures was back in 1984 at Continental Illinois. Now, Continental Illinois was one of the largest banks in the country, and 85% of its deposits were uninsured. And it lost, over a 10-day period, about 30% of its funding. But there was a bigger problem with Continental, and that was that they had an extensive network of correspondent banks, where it essentially was acting as a bank for other banks. And so if Continental Illinois failed, or if the deposits in Continental Illinois were lost, those other banks would suffer losses as well. And so you had this interconnected web of banks that created a real risk if Continental Illinois failed. And so that risk of contagion, it was the beginning of too big to fail, really, because while too big to fail implies that the issue is really the size of the bank, frequently it's really the interconnections between the banks and others because it spreads that contagion we talked about earlier. And so it's one thing to have a bank that looks like another bank. It's another thing to have a bank that has an actual relationship with the failing bank. And so Continental Illinois was a huge problem. To stop it and prevent the contagion, the FDIC had to protect all the uninsured deposits and most of Continental's other creditors. The FDIC and Fed provided financial assistance to facilitate the bailout. And the FDIC ended up taking ownership of the bank. But that was the origin of Too Big to Fail, really came out of that bank run.
So after crises like this, legislators usually want to try to fix the problem so it doesn't happen again. What did they do in this instance?
Well, as always, they always fight the last war. And so they go back and fix what happened last time and don't necessarily look ahead toward the future. But in Continental Illinois, there were a couple issues. First, at that time, many states, including Illinois, they prohibited banks from operating more than one branch. And so that limited their ability to raise deposits geographically and nationally. And so if a bank wanted to grow, it had to look elsewhere for money. And Continental did that. They relied heavily on the Eurodollar market for much of its funding. After the failure of Continental Illinois, and as we went through that time period, they began to loosen restrictions on interstate branching. Banks became national in scope and weren't limited by these kind of restrictions in terms of building their deposit bases and gaining access to insured deposits. Also, you had restrictions being placed by Congress on the use of brokered deposits for banks experiencing financial difficulty, because brokered deposits, which are deposits that individuals give to a broker who then places it in banks around the country, were viewed as a volatile source of funding because they could lead to bank runs. I mean, the customer had no connection to the bank other than through the broker. He was just looking for the highest rates he could get. And so if the bank got in trouble, that money was yanked right out, just the precursor to a run, usually in a lot of cases. And so brokered deposits was viewed as a real problem. The other thing that Congress ended up doing is they began to put restrictions on how the FDIC could handle really big bank failures. And that would come into play over years later in terms of restrictions on how far the FDIC could go to support a failing bank as opposed to just putting it out of its misery.
Well, we'll get into that maybe a little later with some questions, but let's focus on brokered deposits for a minute. Were they the problem at Silicon Valley Bank?
No, they really weren't. The world's changed, not surprisingly. And now with changes in technology, all depositors can quickly withdraw their money. The key distinction between stable and volatile deposits is really whether they're insured or not insured, and not whether they're raised through branches, brokers, or the internet. In fact, the technology is at such a point now that I had a friend who was telling me a story about a customer of Silicon Valley Bank who was in the air the morning that the run started at Silicon Valley Bank. And when he landed and turned his phone back on, he realized he had a problem. And he immediately, while he was on the shuttle bus to his rental car, moved $50 million out of Silicon Valley Bank on his phone. So the runs can happen much faster, much more aggressively today than they could then. And how the deposits get there, whether they're brokered or not, really isn't as significant a factor.
Yeah, you make some great points. Certainly the world's changed, and your comment about fighting the last war seems relevant here. We had a colleague, as you well know, Doug Jones, who said that, we never really know when to stop fighting the old wars. And his way of putting it was that if, a bank failed once because it lent too much money to customers who bought blue cards, then forever after, the bank examiners would check out how many blue cars the bank had and to see if there was a problem, even though the problem may have changed from blue cards to green cards. And I think that's the case with broker deposits. They really aren't the problem anymore. Regulators and examiners need to focus much more on the risk posed by uninsured deposits and less on broker deposits, most of which are insured. So tell me a little bit before we shift gears about Washington Mutual.
So Washington Mutual failed in September of 2008, right in the midst of the financial crisis. It also was a victim of bad real estate lending that we saw that really caused the 2008 crisis. And they'd had a quiet run going on at the bank. And by quiet run, I mean it's one where you don't see the traditional pictures of people standing outside waiting to get their money. This run was more electronic. And over 10 days, you saw about $16 billion which withdrawn. And at that point, that was the largest bank run we'd ever seen. Most of the deposits that ran were business transaction accounts, such as business payroll accounts. And that's not really surprising when you think about it. I mean, those customers are businesses. They're worried about making payroll. They're worried about paying suppliers. If the bank fails and if they can't access their deposits, that's going to spread the impact of the failure through the community very rapidly. On the day that bank failed, one of my jobs at the time was to call the affected congressional office whenever a bank in their district closed. And so I called the chief of staff for one of the congressional offices in Washington State where WAMU was based. And that person started yelling at me about this bank failure. And I was trying to explain to her that this failure should be very calm, that all the depositors are protected. We were going to be able to tell everybody that depositors were protected. But she'd seen pictures of the runs at IndyMac, and she's worried they were going to see something similar across the state of Washington. And no matter how hard I tried to convince her that there probably would not be problems the next day when the bank reopened as branches of J.P. Morgan, she told me that I was naive and that she was going to call the governor and have him call out the National Guard and station troops at all the banks to ensure that people didn't get rowdy in lines. I ended up telling her that one way she could be sure to create a run would be to station troops outside every bank branch in the state. So fortunately, she didn't do it. They didn't do it. And the bank failure went very smoothly the next day. And the run stopped almost immediately once people knew they had access to their money.
So you point out a pretty important issue with the business transaction accounts, and we saw that as one of the problems at Silicon Valley Bank. Explain what the FDIC did at that time to try to limit the harmful effect from business transaction accounts running.
So we just had that failure, and it was pretty clear. We were seeing signs, I think, at other, similarly situated banks of similar contagion risk. And so the FDIC, with the concurrence of the Fed and Treasury, created a program called the Transaction Account Guarantee Program, or the TAG program. And what that program did was it offered unlimited deposit insurance for these business transaction accounts. And to do this, the FDIC had to take a very broad and somewhat controversial interpretation of its statutory authority. What it allowed the FDIC to do, and any bank that participated in it, was to say that nobody has to run on these banks who has uninsured deposits in these transaction accounts. If you're a little bit worried about your bank, as long as your bank's in this program, you're going to be completely covered and you don't have to run. And so the contagion across the country pretty much dried up at that point. You didn't have the run risk because people weren't concerned about their money. They knew the government was standing behind it. And it really prevented probably a number of other, what would have been very expensive runs at other banks. The program was so successful that the FDIC extended it twice, but eventually the 2008 crisis, started to wind down. And so the FDIC decided to try and end the program. And everybody was very nervous about what would happen when they ended the program. Would people go back to being worried about their deposits and run on it again? So actually in 2010, when Congress passed the Dodd-Frank Act, they actually extended it for another 2 years. So this program was actually in place for about 4 years before it could be wound down. And when it was wound down, it was a pretty quiet time. There weren't a lot of failures. And so it happened fairly smoothly. The kicker was that Congress was still unhappy about the FDIC using a fairly broad interpretation of the law to make this happen. And so Congress wanted to restrict that program in the future. And so what they said was, you can do that kind of a program in the future, but you can only do it with congressional approval. And so they limited it going forward. Go forward to 2020, you have the pandemic. And one of the first things that Congress did in 2020 was pass something called the CARES Act, which was a whole set of tools to address the pandemic and the impact on banks, because economic activity was shutting down all across the country. And so Congress stepped in at that point in time and authorized the FDIC to protect these same kind of business accounts. But the FDIC never needed to use the authority, because the type of stimulus that was being used at the time, people were being, if you recall, were being sent checks and that sort of thing. Money was pouring into banks, not going out of banks. And so they never had to actually use the authority. But the people had expressed concern about the congressional limitations on the authority. The people who thought those limitations were appropriate said, oh, see, this just proves that it can work, and you were all worried about nothing. Go 3 more years and you get the run at Silicon Valley Bank. Congress is out of town during that weekend, and there is no way that the FDIC can create a tag program with congressional approval, because Congress isn't there. So the FDIC has to go and look at other statutory authority to cover all the accounts at Silicon Valley Bank and stop the run. And as a result, the FDIC is in a box that weekend, because they can't say that all deposits that are like in Silicon Valley Bank are protected. They can only do it one bank at a time. So the messaging is very muddled. There's a lot of concern. There's a lot of concern about contagion. And you end up having 2 other banks will ultimately fail as well. Again, business transaction accounts were the key at Silicon Valley Bank. And it really shows that they've become the Achilles heel of the deposit insurance system over the past 2 decades. And the limitations that Congress has put on the FDIC's ability to provide emergency coverage, the limitations have really made that power pretty much useless during a rapidly developed run. And so as a result, the government had to take extraordinary expensive measures to stop the run and prevent contagion. And it ended up being a very expensive proposition.
Eric, Tom Weiss here. Incredible perspective on how the response of the FDIC to bank runs really evolved over time to meet new challenges, really because of financial system change, so FDIC had to change over time. Just to go back to Silicon Valley Bank for a minute, the speed with which depositors withdrew funds from that bank was really unprecedented. Why the dramatic difference from prior episodes?
So I think there were several things that made the run at Silicon Valley Bank different. And, again, it was $42 billion in a single day and $100 billion in line to go out the next door. Our record prior to that was, had been crushed from Washington Mutual. You had today's more advanced banking tools make it easier to remove money faster than ever before. But Silicon Valley Bank, as its name indicates, was sort of at the forefront of technology. And so they were one of the first bank runs we've seen that was, if not triggered, at least exacerbated by social media. And concerned depositors, where it used to be word of mouth and people seeing people lining up outside the bank and that sort of thing that would cause runs, here, concerned depositors could communicate with each other directly on, at that time, Twitter, I guess now X, and various other social media. And so they were able to develop essentially collective action much faster than we'd ever seen before. And then you had the additional impact that the concentration of uninsured deposits were in a single industry. I mean, Silicon Valley Bank really was focused on providing funding for tech startups who had received venture capital money, and their venture capital contributors wanted to be sure that that money was not lost in the bank. And so there was a lot of pressure on those companies to get the money out of the bank as fast as possible. In fact, I think a number of folks had told them that, if you're not doing everything you can to get your money out of that bank as fast as you can, you're not fulfilling your responsibilities as a CEO of your startup. And so there was a huge amount of pressure on those institutions, a lot of communication that just really ramped up the speed of that failure.
So what are your thoughts about really how social media might contribute potentially to future bank runs?
The social media part of it really worries me because that feeds into that psychology in a very visceral way. I mean, people are so into that now that and spend so much time on it and look at it so unquestioningly that that's, I think, a real risk going forward. So I think there's a lot of concerns about the potential for social media in the future. Social media has a very broad reach, as we all know. People are on it constantly. But there's a bigger problem, I think, with social media. Studies have shown that misinformation and disinformation on social media spread much more quickly and widely than truth. And this really increases the chances that false information can trigger bank runs and that it will not be an effective deterrent. You can't just tell the truth as an effective deterrent to stop the run once it starts. I mean, some have called it, have said basically you can't fight the fire hose of information with the squirt gun of truth. I mean, it's a very difficult circumstance to try and regain confidence when you have these kinds of runs going. And then you layer on top of that the rapid developments we're seeing in artificial intelligence. And so you've got AI tools that make it very easy to create realistic pictures and even video, perhaps showing a line at a bank or a bank refusing to give customers their deposits and then spreading that through social media. All of this makes it really much more difficult to, first, it increases the risks of potential runs, I think, based on misinformation. And it also makes it that much harder to stop. I mean, the risk was always there. Rumors have always been an area that has acted as a trigger for bank runs. And the fact that we now have created tools that make it possible to share that with everybody very quickly is a real risk, I think, going forward.
It's interesting you bring that up because one of the things we try to do here is bring perspective of history and how it may relate to the current situation. Mark Twain in the 1850s, 1860s had a quote that is very similar to what you're saying. He said something like, a lie gets halfway around the world before the truth gets its boots on. This is 170 odd years ago. So those some things never change, I guess. We've seen runs in other parts of the financial sector as well. And I know you've got some experience or know quite a bit about money market funds. What happened there?
So money market fund is basically a mutual fund that invests in short-term liquid deposits. It offers high liquidity and low risk, and it tries to maintain a stable $1 share net asset value. And what that essentially does is it's a way for non-banks to offer something that looks very much like a bank deposit product. But it often pays higher rates of interest because it's not as regulated as banks are. And they're not insured by the FDIC. And so in 2008, after the failure of Lehman Brothers, one of the large money market funds suffered losses as a result of the failure and bad investments in subprime real estate. And it, what they call, broke the buck. In other words, the account holders could not get all their money back. It wasn't $1 per share. And so this caused a run on money market funds. And the run was only stopped when the Treasury Department stepped in and promised to insure all the investments in money market funds. Now, that in and of itself, on that day they did it, created some problems because now you have a product that they're offering unlimited coverage for that pays a higher interest rate than bank deposits backed by the federal government. So what's going to potentially happen? You're potentially actually going to set up a situation where you get deposits running from banks to money market funds. And so people suddenly realized that morning. And so by noon, they had dialed that back a little bit, and Treasury said they would fully insure and support all the funds that were in the bank that morning, but they wouldn't do it for new money to try and prevent the run going forward. But during the pandemic, you got another run on money market mutual funds, and Congress again authorized the Treasury Department to step in and guarantee those products. So money market mutual funds have been run risk prone in the last couple of financial crises.
So what was done to address the problem?
So following the 2008 crisis, the SEC attempted to limit the runs on money market mutual funds, and the reforms were designed to basically slow down the withdrawals in a crisis to give people time to think about what they're doing, somewhat similar to what the SEC does for markets, where if you have sharp increases or drops, they have what they are known as circuit breakers in the markets that prevent that from happening too quickly and lets people take a breath and decide what they're going to do. And so they had fees and temporary suspensions of redemptions called gates that they put in place to try and slow down any run and prevent things from getting out of hand.
Well, did that solution work?
Not a bit. In fact, the reforms were tested for the first time in the early days of the 2020 pandemic, and the studies that went and looked at it indicated that the investors were well aware of the fact that the gates might close and the fees might be there. And so they actually ran faster, and they moved up the run, and the reforms actually contributed to the runs at the money market funds, which was the opposite of the intended effect. The clear lesson is that you cannot slow down a run by telling people they cannot have their money. And as a result, money market mutual funds are still pretty much susceptible to runs during an economic crisis today.
Interesting. Just to follow on your comment, they can't slow down a run by telling people they can't have their money. Private markets have been in the news recently, and even though it's well advertised that immediate liquidity is not a feature in that market, we've seen at least one high-profile company rethink its approach to liquidity, essentially restructuring one of its funds, seemingly in response to investor concerns. So any thoughts on the concepts of runs in that market, which of course is outside the regulated banking system?
Yeah, I mean, it's sort of indicative of what we've seen before. I mean, it's just not anything really new happening there, except for the fact that they are, at this point, smaller. It's more contained. It's more limited. So you don't have as much of a widespread run. But for those companies experiencing this right now, you have a lot of unhappy customers. And you also have that industry has been looking to build their retail base and try to get into things more like 401ks and be an investment for 401ks and that sort of thing. And I think the experience of the fact that people can't always get their money when they want it is going to have an impact on their ability to make that case going forward. But at a minimum, you've got a number of unhappy customers, and it remains to be seen how many people will view those as an investment they really want to be heavily in the future going forward.
Interesting. It sounds like a lot to be worried about these days, even beyond the private markets. Your discussion of money market mutual funds, it sounds a lot like stablecoins as well, since both require 100% backing by safe liquid investments like short-term government securities.
Yeah.
What'll happen if a stablecoin breaks the buck?
Stablecoins are really an interesting thing because, first of all, they've already broken the buck. Almost every major stablecoin has lost their peg to the dollar for at least a period of time in recent years. And so it can occur because of events in the crypto industry, such as the FTX failure or issues in the broader economy. Silicon Valley Bank was a prime example of that. There was a company called Circle, which is, I think, the second largest stablecoin in the country. And they had $3 billion in uninsured deposits at SVB supporting its stablecoin. So when the bank failed, and initially it looked like the depositors weren't going to get all their money back, you had a run on the Circle stablecoin, and its value dropped from $1 to 87 cents in one day. And so the full coverage of uninsured deposits in SVB actually solved that problem because now it meant that the stablecoin was fully backed again. And so the solution to the bank run solved the run on the stablecoin in that case. Now, the concern that I would have is the fact that these runs can go in both directions. I mean, you can have a bank run that creates a run on a stable coin, as we did in Silicon Valley Bank. But you can also very easily envision a situation where you have a stable coin run where they're having to pull money out of the bank to support the stable coin that triggers a bank run. So you've got mutually feeding runs that are layered on top of each other. And so as banks get into this business and as banks start to offer stable coins on their own, you're going to have the potential for confusion. People aren't going to know necessarily what's insured, what's not insured. The Genius Act, which sets up the structure for stable coins, says explicitly stable coins don't qualify for deposit insurance. But you can just tell that a run on major stable coin or major stable coins as we go forward, it's going to look a lot like a run on the money market funds. And so as they become more integrated with the banking system, the pressure, the confusion, the complexity is going to grow, and people need to be thinking about that. You're adding one risk to another. And then you have the additional thing that the Genius Act allows stablecoins to be backed by money market mutual funds, which we just talked about. So you've added yet another product that has a run risk to the equation. So the prospect of future runs, not just in the banking system, but through an ever-growing part of the financial system is large. It's growing. And Congress's strategy of just sort of ignoring that problem and hoping it'll go away, or just declaring that certain assets will not be protected, isn't, I don't think, going to be sustainable in the long run. I mean, Mike Tyson said that everyone has a plan until they get punched in the face, but here it doesn't really feel like we even have a plan at the moment.
Okay, before we get too far in scaring everybody to death, do you have a plan?
Well, I think that following the failure at SVB, the FDIC issued a report on ways to reform deposit insurance to at least address this problem in banks. And they offered three options. And the first was keep the current system, just raise the coverage levels. The second was provide unlimited coverage for all deposits. And the third was do what we've done before, provide unlimited coverage to this targeted class of business accounts. And they generally seem to think, and I tend to agree with them, that that targeted approach did the best job of balancing the competing interests. You weren't insuring all deposits, but you were insuring the ones most likely to run. The advantages of doing that, creating a tag-like program there, is if you set up a program, instead of doing it ad hoc every time you have a crisis, you can actually price the risk. You can appropriately set up a system that matches the risks with the premiums, and it's got to be a better system than these repeated ad hoc jury-rigged systems that we keep putting in place that we know are enormously expensive. And the advantage of this is we know we can't stop or slow down misinformation or disinformation on social media. So the one thing you can do is try to address the underlying fundamental fear, and that's going to do the most harm to the bank. And these business transaction accounts and runs in the business transaction accounts are really, I think, probably that area. And so we know that we're going to cover these accounts. In the last 15 years, we've had 4 times where we've had runs or fears of runs that are triggered by these business transaction accounts. And in every one of those instances, the government stepped in to protect those accounts. So, we know the government's going to do it. Everybody's depending on it, assuming it, pricing it that way. So, why don't we formalize the program and prevent the major source of bank runs before they happen?
So, to play devil's advocate, wouldn't such a significant expansion of the government's safety net create even more moral hazard? I mean, aren't there alternatives that could preserve some market discipline? Say significant advanced dividend to uninsured depositors when there's a problem, so they can meet their liquidity needs like payroll and don't quite suffer quite as much?
Well, I think the moral hazard ship has probably already sailed at this point. As I mentioned, I think people already assume, and with good reason, that the government's going to step in and cover business transaction accounts in a crisis. one way, if you did have a program in place, that you could begin to get some of that discipline back in the system would be to charge risk-based premiums for this program at the front end, and especially including charging more for people who have large amounts of uninsured deposits who pose a greater risk. There are obviously other alternatives. As for the advanced dividends, a lot of people don't remember this, but on the first night of the failure, the FDIC announced an advanced dividend, and it did not slow the run one bit. It goes back again to the fact that telling people that they're only going to get a part of their money or that they can't have all their money generally doesn't slow down the run very much. And we saw the same thing with co-insurance that was in place in England during the 2008 crisis. Even though 80% of the bank deposits were covered up to the insurance limit, runs still occurred. So nobody likes to lose any of their money in these run situations. And unless you're really not going to be able to stop a panicking run by telling people that they can have part of their money instead of all of their money.
To your point, Eric, that bailouts are inevitable. It has amazed me how quickly government officials have routinely jumped in to authorize government bailouts, even though it requires now 2/3 approval from the FDIC board, 2/3 approval from the Federal Reserve Board, the Secretary of Treasury agreeing after consultation with the president. It was meant to be a high hurdle, but it doesn't seem that way. It seems like everyone's got the view, not on my watch. Is there going to be somebody losing money? And it almost seems like the process has made it even easier for bailouts to occur, because it's not just one person taking all the heat. Everybody can say, well, all the rest of them agreed to it, so it must be the right thing to do. It just wasn't what I was expecting when everybody was saying no more bailouts after each crisis, that yes, bailouts are routine and automatic now. Let me ask you before we wrap up, there have been a lot of recent proposals before Congress related to, raising the deposit insurance limit on business transaction accounts. And they've kind of said anywhere from 10 to 25 million per account, but only for banks with total assets, below 250 billion, because the large banks don't need it. As you point out, they get bailed out anyway, but the small banks do. So let's raise the coverage there. And while that would benefit small banks, I guess, it wouldn't solve the fundamental problem. The incentive to run at large banks would still be there. So why all this hullabaloo if it's not going to solve the real problem?
Well, I think a couple reasons. First, I think you're right. I think Congress is addressing the problem that is most in front of them. And the problem that's most in front of them is a lot of angry small banks who, whenever there's one of these crises and whenever there's a bailout like this, money tends to flow out of the small banks to the larger banks. And so they're trying to give tools to address the problem they see in small banks and let the small banks provide some additional level of coverage. But the problem, as you point out, is much larger. And so you're going to have some runs potentially at some pretty large banks, even with these proposals. Plus, even if you assume it applies to banks of all sizes, the levels being discussed, 20 million or 10 million deposit insurance coverage levels. I'll remind you, I mentioned a minute ago, Circle, their deposit at SVB was, I think, $2 or $3 billion. So they're not going to take a whole lot of comfort in this in terms of feeling like they're protected. I mean, if damaging bank runs are the issue you're trying to address, and the place where that keeps showing up the most are business transaction accounts, it seems like that's where you need to address it. Now, at a minimum, the one other thing Congress could do, if they're not going to do that, is to at least take away the restrictions that prevent the FDIC in an emergency from creating a tag program to get us over the hump of a particular crisis and not have to get congressional approval to do it. given the timing issues. I mean, certainly you can have accountability, you can have FDIC and Treasury and Fed have to testify about it later and justify it, et cetera. But right now, not having that tool available on a weekend where you have a crisis is a real problem. And even if you don't solve any other problem by doing something special for business transaction accounts, having the FDIC with that authority and flexibility, the same authority and flexibility it had in 2008, 2020, would be beneficial, I think, in an emergency. And so if Congress does nothing else, and the odds are that they won't, they should at least lift those restrictions and provide greater flexibility to address a crisis.
So just let me explore one more part of this. You're arguing basically that if you're going to cover business transactions, let's just do it completely because nobody wants to lose any money. And if you have this cap, you're still going to have bank runs. But wouldn't the cost for that be fairly prohibitive? The Taxpayer Protection Alliance estimated that even if the coverage just went up to $25 million per account, it would cost an extra $30 billion in premiums for the banks, and that I would assume that would be pretty rough for the small banks in the country and costly over time to maintain the deposit insurance ratio with this much higher level of coverage.
So the thing we've already seen from the failures is the failures have been enormously costly, where we've had to do this on an ad hoc basis. In fact, you mentioned the $30 billion. Well, $30 billion was about the cost to the FDIC to handle the 2023 regional bank failures. And most of that was from protecting uninsured depositors. So you could reduce some of that cost by having premium payments restructured in a way that addresses risk, assuming small banks pose a smaller risk to this sort of thing. But the key element here, I think, really is if you have a program in place that provides that kind of level of assurance and protection, if you don't have the run, you don't have as much of the costs. And so I think it's a difficult issue because it looks like we're paying the costs either way. You can either pay them up front and try and calibrate them for risk, or you can pay them afterwards when you know where the problem is. But either way, you're probably going to pay them.
Well, we're going to have to stop for today. But Eric, thank you for being here and for such an interesting, informative discussion. I think you've done a great job of presenting the arguments for expanding coverage for 2 business transaction accounts. I think we should explore this issue a little more in some future podcasts, because legislators and regulators face quite a difficult balancing act, and too little deposit insurance coverage fails to prevent bank runs, as you've pointed out, while too much coverage removes any potential market discipline. I think maybe in future episodes, we will come back to the fact that there are some other potential solutions that involve some degree of market discipline, but we've clearly got to find some solution. As you say, the damage from bank runs is becoming more severe, with the speed at which a run can occur now, leaving virtually no time to react. And as you pointed out, the runs go well beyond the banking system to at least money market mutual funds, private credit, stable coins, all markets with no deposit insurance. So in our next episode of Banking Bad, we'll continue this discussion and explore the appropriate role for a lender of last resort and see if we made that more effective, if that can be of some help. So please join us then, and thank you for this great discussion today.